This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse here with your Forex Report. We are wrapping up the week. It's Friday, July 27th, 2007. Well, this was one of the most volatile weeks we have seen in the Forex market in many months. Not since the Chinese stock market plunged 9% in one day have we seen such strength in the yen or weakness in most other major currencies. As subprime mortgage woes in the U.S. resurfaced and intensified this week, U.S. stocks took a dive. This, in turn, led to a global risk aversion and allowed for a much-needed correction in carry trades. The dollar benefited from the havoc as other currencies that were trading at multi-year highs against the U.S. and Japanese currencies took the biggest hits. Of course, we wouldn't call this the beginning of the end for the dollar or yen weakness. We believe that there are simply too many speculators still ready to prey on both of these currencies when prices look right. Therefore, traders can expect volatility to remain high in the short term. Some of this week's most important U.S. data included new and existing home sales, durable goods orders, and GDP. As expected, both new and existing home sales declined, and by more than economists had forecast. New home sales fell 6.6% in June, nearing the slowest pace in 7 years. This data suggests the housing recession is not finding a bottom just yet. Durable goods orders also came in shy of estimates, with the ex-transportation number unexpectedly dropping 0.5%. This raises doubts about business spending contributing to growth in coming quarters. Finally, today's GDP report beat consensus estimates, but the breakdown confirmed the fears of skeptics. While second quarter GDP was reported at 3.4%, consumer spending slowed dramatically to an annual pace of just 1.3% from 3.7% in the first quarter. This indicates that growth stemmed from companies restocking inventories rather than bottom-line demand, and suggests that the second quarter may be the strongest of this year. Now on to the big picture. The carry trades finally began unwinding this week as traders took profits in response to a plunge in U.S. stocks. As we have said a number of times, yen's strength will come on the back of risk aversion and outside influences, not rate hikes from the BOJ. The yen gained the fastest against European currencies, which were trading at all-time highs against the Japanese currency. This made it possible for the dollar to claw its way to a weekly gain against some of these currencies as well, although the buck did lose significant ground against the yen too. The U.S. fundamental backdrop remains weak, which means that we cannot expect a reversal in the bearish dollar trend just yet. However, if carry trades continue to falter in the near term, it does open the door to at least some buoyancy in the greenback, if not a little further strength. Many currencies have become incredibly overbought against the dollar and yen as traders see potential for higher interest rates in coming months. Of course, expectations of strong growth and rate hikes in these countries have been heavily priced into the underlying currencies. In the short term, this leaves such currencies vulnerable to any slight downside surprise in data. We do not foresee another big dollar sell-off in the immediate future, and therefore will now approach the market on a strictly short-term basis, looking for both long and short dollar opportunities. Till next week, have a wonderful weekend. Take care.